This is Searchers.com, hosted by Dr. Alexander Hoffman. If you're into entrepreneurship through acquisition and search funds, you'll feel at home. Each episode breaks down a real acquisition, talking to the buyers, brokers, lenders, and operators in the trenches, so you learn what actually works. Let's jump right in.
Today, I'm sitting in front of, virtually at least, in front of Brett Sleyster. Did I pronounce your name correct?
More or less.
Okay, thanks, Brett, for being here. Where are you based?
I'm in Texas, smack in between San Antonio and Austin, in a small town called Canyon Lake.
I'm based in Munich, for those people who don't know, so we're stretching quite some distance now, but we try to reduce the distance among searchers globally, uncover stories of people who walk the path to inspire those who are still sitting there thinking about doing it. Yeah, and Brett, let's dive into your story. Maybe let's start with one thing that struck me when I saw your LinkedIn. Chemical engineering was the start. How did you get from chemical engineering to searching and finding deals, buying a business?
The start at the beginning, I was chemical engineer trying to go into the kind of energy, oil and gas industry. Oil prices were about $120 a barrel, and they dropped to $40 a barrel. Then you can take a guess at who wasn't hired. My dad had worked in the financial services industry. The financial services industry recruits a lot from Northwestern. So I decided to look down that path, really jumped into it, had one internship at a mezzanine lender, and then had the opportunity to intern at a search fund back in undergrad, which was about 8 years ago at this point. So had a good experience there that stuck with me, but I went and did the things you go and do for your first job out of college. I worked at a very large bank. It's called Credit Agricole. Alex here probably knows it, but for all the Americans, we like to call it the biggest bank that no one's ever heard of. I mean, it was a good experience. I was just intrigued by the idea of, I was working for an MBA who had just graduated from Booth. He was looking to go become CEO fairly early in his career. With great guy, very personal, very smart, but nonetheless pretty modest experience. And he was able to point me to the data that said, yeah, despite all that, it works out pretty well a good portion of the time. And as someone who was pretty ambitious, that stuck with me as I went and did other things with my early career.
Nice. And I feel like internships, in particular search fund internships, like for you students listening in, just take the chance. And on Searchers, I have a form as well for people to sign up for internships. Just keep that idea in mind, because it was the spark for Brett going to that world. What happened then, Brett?
Until all the potential interns listening to this, not all search internships are created equal. Do ask the people you're going to be working with what sort of mentorship they're going to do, what they're going to do to help you actually learn financial aspects. 95% of the actual work you do will be finding email addresses and contact information. But if your searcher is being good to you, they should take a little time out of their day to, run a case study on one of the deals they're looking at or what have you. So ask your searcher how they do that piece of the puzzle. Because actually, I will say, finding email addresses, insanely useful skill for the rest of your career too. So don't underestimate that one either.
It's a lot of good skills to be learned, but still things to be checked. Great advice. And then, Brett, you went into the bank, but the idea still resonated with you of the internship you did, of buying a business. What happened then? How did you proceed?
Yeah. So I was working in banking. We were effectively working with very large corporate, mostly public entities across several different unrelated industries, which gave me good exposure. We weren't the M&A team. We did everything else from acquisition financing to term loans, bonds, structured finance. But basically anything you can imagine other than M&A, we touched it and had a large impact in that for our clients and dealing with very large sums of money. Yeah, while I was there, was learning the basics, was promoted from analyst to associate after a year. But at some point during COVID, I found myself up at 2 a.m. making sure some compliance workflows got through, and I decided I couldn't do this for the rest of my life. Also, I probably would have had to move to New York for the next advancement in my career, and I didn't want to go live in New York, so I had to figure out what was next. I was actually looking at going and working in private credit. There was a little thing at the back of my mind that maybe I could go to this private credit fund. I think search funds are growing. I could become a lender to that. And then COVID happened and the hiring process that I was in completely stopped. Then basically by dumb luck, I had the opportunity to go work at Prudential Financials, effectively their corporate venture arm, though technically it was an independent fund. Doesn't really matter. But I knew that was going to be a short-term gig, a pre-MBA gig. And while I was there, really enjoyed talking to, working with the entrepreneur, seeing everything they were building for their clients, their employees, and themselves, and just thought I wanted to be on the other side of the table. So going back to business school, I had the opportunity to do the one-year program at Kellogg. I was also in at Booth, and just the one-year program seemed like a better use of time, energy, and money, despite the fact I already had Northwestern on my resume. Uh, but the two thoughts that were potentially in my head were see if I can go back to venture or go do a search fund. Ultimately decided I wanted to be one of the ones really building a business, creating the value rather than simply participating in what others were creating. Not that that's easy, not that there's anything wrong with that. It's just in the value stack, that's what I wanted to be doing. And so I went back to Kellogg with the plan of doing a search fund on the other side of it. While I was there, was able to intern at a search fund again, People First Capital with Hereford Johnson. He helped mentored me. He introduced me to quite a few of the investors who ended up backing me, and then quite a few investors come to campus, and some of those wanted to back me, and they also connected me to the other ones who filled out my cap table. Was able to raise that during school, which is pretty typical if you're coming out of one of the top MBA programs, and then I was off to the races.
Amazing. And you chose like a typical search fund vehicle. Like, how did you set it up? Did they give you a lot of money up front? Did you say, I go independent for a while? What exactly did you do with it?
So, you know, I looked at the self-funded model, I looked at the traditional model, and I do think there's a lot to say for the self-funded model, but my wife told me, do what you want, but have a paycheck. So it made it a relatively simple decision.
I love the honesty. And for people who are in the same position, would you do that step again? Or do it somehow differently, or anything to consider when doing that?
Um, I mean, in my shoes, the traditional model was the right decision. At the end of the day, if you are a young entrepreneur who really wants to bet on themselves, wants to get a deal done quickly, and you're geographically flexible, I think it's much easier to find a deal if you're self-funded. You can just go on Biz Buy Sell. There's probably 50 of those companies that get listed every 2 weeks. And if you're really willing to move anywhere, one of them will sell to you at an appropriate price in an interesting industry. But if, you have assets you need to protect, if you have a spouse or kids that you need some level of income for, or just the risk aversion of not wanting the personal guarantee, which is completely reasonable. Traditional is a great path that offers you the opportunity to buy a bigger business, which certainly has some benefits too.
To stay on that topic just for a second, what did it mean though then? Did you found an LLC directly? What did it formally mean? Should people get lawyers directly? Should they set up complex contracts? Anything really on search fund day number one?
Yeah, there's a handful of law firms at this point that know what search funds are, know how to set them up. They'll generally do the LLC for you. They're going to put it all in a package. They're going to charge you 5,000 up front, another 5,000 if you close the deal. They'll set up the LLC. They'll set up your investor docs, and yeah, there was an LLC. Let the lawyers handle it. They're pretty standard packages. Talk to a few of them, see who you get along with. I only have good things to say about Ron.
Yeah, I feel that the entire model is very often just associated with the search fund itself. While there's so many forms you could go into, as you mentioned, independent, whatever, basically. Yeah, I think just to stay open-minded there, although the search fund model is really well proven, I would say.
Yeah. I guess the other one that I didn't really seriously consider is the sole sponsored model, the next gen growth partners, the broad trees. the Novastones of the world. And what I have generally heard about them is that they have a relatively small box of the number of deals or the types of deals that they're going to let you look at. And I don't think that's the worst thing in the world, but you need to know what you're signing up for. You get the advantages of having committed capital. You get the advantage of often having very structured intern programs. You get the advantage of people who you can really call at any time to help you do diligence on a deal. And I'm sure there's some other resources I'm not aware of, but there's a smaller box.
Now let's go to day 2 in the search fund that you just set up. You were lucky, you had a great educational chance there, got investors, have that LLC. What happened then? Were you the one looking for emails? How did you find deals?
Yeah. One thing you're gonna get out of this is that a lot of what happens in search is serendipitous, but yeah, I did the thing that every searcher does as they're getting things going, and I do think you should do it yourself for a little bit before you go get help. But I was finding emails, I was contacting brokers, I was getting lists of companies from industries and having people on Upwork or Fiverr go fill them out. I was validating those emails and sending them out in relatively high volume.
And was that mostly proprietary outreach, or did you also rely on brokers and marketplaces?
Definitely all of the above, proprietary, brokered. I included both of them. I've certainly spent more time doing the proprietary, although like most searchers, you end up finding roughly as many deals to look at through the brokered channel. Obviously, there's advantages to both sides. Advantages of a broker's person is serious and ready to sell. They have their financial information typically pretty well put together. If you go low enough down the market, there's always going to be some competition, but it can be less than you might think. On the downside, I mentioned that there was competition, but you find a really attractive target, there's going to be a lot of competition. Brokers are skeptical of searchers a lot of the time because the capital's not committed. So you need to get your story down on why, if you go after that deal, the capital is going to show up come deal time, uh, and all of those good things.
All right. And if we now think about the deal criteria you had, when I did my research a while ago, I noticed that there's some people who have really their system dialed in. They know the location, they know EBIT ranges, they know the industry. What was the process for you? Did you already know one of the criteria? Did you find them out over time?
I had been reading and learning about search for a pretty long time before I actually dived into it. I knew this. And if you sign up to be a traditional searcher, they are looking for certain criteria. Good news, no deal's ever going to fit all of them, so you shouldn't feel bad when your deal doesn't fit all of them. But the more you can fit into growing quickly, uh, recurring revenue, defensible industry, light on capex, able to find talent fairly reasonably, the better the deal's going to look on paper. But no deal's ever going to look exactly like that. And I ended up going into the addiction treatment industry. And if you're doing your job well, and we're a very high quality facility, you do not want your customers or your clients to come back, and we really hope they do amazing after they leave here. We're not only in the healthcare industry where there's talent can be hard to come by, uh, but also we're in a relatively remote area. So we're trying to get healthcare workers in a remote area. There are big advantages to owning the buildings in this space. So you end up having a little bit more capex in other industries. Nonetheless, there's quite a few tailwinds in the space, and we were able to make a deal that works for everybody. I tried to stay close to the criteria. It's not always how it works out. And there are good companies that don't perfectly fit the criteria.
100%, 100%. But now you gave away already your current business model. Let's understand though how, like you said, addiction treatment, but how did you ultimately find the deal? Like what happened there? We had the fund, you had made your first experiences in search. Was that deal on a broker website? Did you do cold outreach? How did you find it? And how did you move ahead there?
Yeah, so I basically got lucky. I founded the fund by myself, but a friend of mine who went through the Zell Fellows program at Kellogg with me was looking generally in the healthcare space. I was not looking in the healthcare space. and a buddy of his was only looking at outpatient behavioral health. So he had found a brokered deal. They said, it's not for me, but it looks like an interesting company. Why don't you look at it? And then it was a bigger deal than a deal typically is for the search space. So my friend brought me in and said, let's look at this together. And then my immediate reaction was, uh, no, I don't want to work in this industry actually. Because my brother had pretty severe addiction issues. Other people in my family have had pretty severe addiction issues, and he had some bad experiences with the industry. But he said, "No, no, this place it really cares about outcomes. It really cares about doing things the right way. Come look at it." So I came for uh, a seller meeting, and we pursued it.
It sounds really interesting. And again, you being lucky of having the right context there. You
But
said that the
but it was certainly luck. But part of being lucky is being open to opportunities that don't come from the channels you.
and I 100% agree. I always viewed like the more sales you set, the more you increase your opportunity surface, basically, the higher the chance of luck actually is meeting you at one point. And it sounds like you exactly made that. Let's quickly, like without going to the deal details, but suddenly the deal was bigger. What did it mean though for you? Did you suddenly need to find a bank? Were the investors able to go with you? Any learnings? I'm trying to transfer anything for people being in that situation, finding something bigger than they looked for initially.
We did need to go find banks, and this was a mostly out of network healthcare facility, which for those who are not Americans, in network means you have contracts with all the major insurers. Out of network means you don't have contracts, and every patient you bring in is kind of a negotiation with the insurance company. It creates some uncertainties that banks have a tendency to not like. We certainly talked to more than a dozen banks throughout the process, ended up getting two term sheets, one from one of the traditional search lenders who is well known within the space, and one from an SBIC. And we ultimately went with the SBIC. But it was a bit of a slog of a process. And that was even with my background being a credit guy, I could speak to all the things that were good about it. But for a lot of the banks, it was well, a lot of banks don't like the search fund model because young leaders with some guardrails, but ultimately they're the one day to day running it. And then, they don't know you as a well known, they just haven't worked with you before, which is a related, but on its own an issue. And then add that it's a out of network healthcare issue, a bit of a larger check because it was a little bit bigger. So we have to work hard to go find the lender. And believe it or not, I it was anonymous, but I put a post on Search Funder, got reached out to, and that's how we ended up connecting with the lender we worked with.
Were there any learnings though you made during the process? I'm just thinking, for example, timing wise. Like typically you have your LOI, then there's ideally an exclusivity phase. How did you structure timing, or yeah, any tricks there? Any learnings you made?
Well, we're going to go back to our deal not being normal. We got into diligence, and we then had to renegotiate the deal. So that extended the period. And then we were also buying real estate with the deal. And if you're buying real estate, you have to do surveys and a bunch of other things that just end up extending the period. So I think when all was said and done, we were in diligence for 7 months, although some of that was preventable and some of that was not, because I don't think we had a good way of knowing some of the things we found until we were into diligence.
Uh-huh. Interesting. And if you think, if you would start fresh to being a searcher, for example, when would you start to speak to a bank? Would you already start to speak to a bank even before having a deal in your hands? Like getting yourself known, getting the background conveyed of what you achieved so far?
Yeah, for most people who at least are going down the traditional search path, you've probably been to a few of these conferences before. The major lenders are at those conferences. I would take 5 minutes to go and introduce yourself to, Avid Bank is one of the major ones, Bank Prov. I'm blanking on the other ones, but there's about four that show up at almost all these things. It is better to have had an introduction before you need to ask for money. have some sort of relationship and then build on it when it comes to deal time. It's just better to work with people that you know what they're looking for. You can say, we talked about you being interested or open to XYZ. Well, now I found a deal in that space and it's great because instead of here's my background, here's why you should trust me at all.
I think that's really good advice. And I think sometimes it's really easy to get to hide behind building pipelines, finding emails and everything, but really go out, go to conferences, get to know people, yeah, and extend your surface, your opportunity surface, as we just mentioned.
Yeah, but even doing that while you're in business school, if you're going to the Harvard, MIT, or Booth Kellogg conference, they're going to be at all of those. You can keep it quick, but having being able to say, I met you before is a pretty powerful thing. Oh, and there's one unsolicited piece of advice I give to all searchers when it comes to fundraising, and it's just related. However early you wanted to start talking to investors, start earlier.
Because time kills deals if you need too long at the wrong point in time. Yeah.
Yeah.
All right. So where did we end now? You found the business. You've taken your 7 months. Now you're closing. Let's quickly touch though on deal terms without the need of you going to the specifics there. But if you think generally about deal terms, what should people like? What are mechanisms you think are really favorable and worthwhile? Would you always consider an earn out, for example? Would you always push for a seller loan? Are there any thoughts, experiences you made on those?
Um, we did have an earnout in ours. I think it is better to have some sort of alignment with the seller post sale, whether that's a seller note, whether that's rollover equity, I think is a little bit less important, though that it's enough that they're going to, you know, take your call, realize it's important to them that this thing that needs to happen happens, and then they help you work through whatever the issue is, what you're aiming for. What's material in any given sale is going to be different, and what matters to any given seller is going to be a little bit different, though money's almost always going to be important. Does that answer the question? Anywhere you'd like me to dig in a bit more?
Um, no, I think I think good. I was just thinking on covenants, for example, or put differently, I feel that people tend to overcomplicate those contracts, and they go into too much nitty-gritty details. While multiple is number one, of course, earn out alliance incentives. Seller loans are also interesting. Like, I feel if a seller loan is at zero or somebody really blocks, for example, in a German setup, I asked somebody for a seller loan and he said, no, forget it, I'm not a bank. And that gave me directly a signal, oh, maybe like I should dive deeper on how hard he wants to make the cut. If he's again also saying earn out, no chance, I have my second signal, which feels off. I want some post-deal commitment. Otherwise, there might be something lingering, and then I need covenants or whatever.
Yeah. Look, I think I said this once before, but you need to make a deal that works for everybody involved. If you could buy a business for, let's call it a ridiculous multiple of like 2x, maybe you go buy it all cash and say, I don't know what's wrong with the business. There's almost certainly something that they're letting go of it, but I'm pretty sure I can deal with it just because I'm paying so low of a price and I know XYZ about the industry. So it will be okay. Once you start stretching the multiple to, the high end of valuations, let's assume for a non-software business, you're paying 7 times. Well, then you really need to execute very well for the returns you're promising your investors to work out. And so you need to be confident in growth. You need to be confident margins are going to stay roughly where they are. You're probably trying to reduce the amount of equity you're putting out through that earnout or seller note. Just again, making those returns work is a little bit harder. So how much you need to align those incentives or how much risk you're willing to take really is individual to the deal. The lower price you're paying, the more you might be willing to just not do the seller note because incentives don't have to be aligned. You've mitigated risk in other ways.
Maybe though on mitigating risk, I want to go to day one of you actually signing the deal and being in the company, but let's still stay a second on due diligence. Did you have accounting partners, QoE service partners, or was it you and your friend being in all documents yourself?
So yeah, we used a bunch of third-party diligence providers. It was a healthcare deals. So you need to do billing and coding diligence. You need to do the usual Q of E. You wait till closer to the end to do legal diligence because it's very expensive, but you need to do legal diligence. We were buying the property, so we had to get a site survey called an Alta survey done, and a couple of other items related to literally buying property. We did a lot of expert calls, and some of those were paid through Tegas. Some of those were just people we got connected to. And then we actually talked to some banks that worked in the space, and they were able to give us some insights. We talked to some brokers who were active in the space. They were able to give us some insights. So all of those came together to be our diligence package, on top of just talking a lot to the seller and the CFO at the seller, their understanding of the team, the business, where the opportunities and the risks were.
Sounds super professional, but also mitigates risk, as we just said. So now day one is there. Did you have proper SOPs? Did you know what to do on day one? What did you do on day one, day two, day three? What happened?
I mean, on day one, we were mostly just talking to various team members. Yeah, just talking to the leaders of the business. Where in behavioral health, so it wasn't the first day, but over the first couple of weeks, we tried to talk one-on-one to all of the clinicians. We wanted to understand what was important to all these people. What did we need to know to allow them to do their jobs? Telling them our vision for the place. In retrospect, we didn't over spend too much time on that, but that time probably would have just been better spent listening. There were still various types of paperwork that still needed to get cleaned up immediately post the transaction, but certainly a whirlwind.
I can imagine, but listening is the key in the first phase. Let's jump to where you're now, though. Is the deal turning out good? Are you happy? Any surprises you made down the way? Where are you now? And please repeat also the company's name, and if you want to, and place it properly.
Yeah. My business partner is the CEO. I'm the CFO of Windmill Wellness Ranch, a residential addiction treatment center here in the heart of Texas. And we are a very data-driven business in an industry that's often touchy-feely. We do a lot of things that we think allow us to have better outcomes than our typical. We only use master's level clinicians. We use this third party called Track 9 to measure our outcomes both during and after treatment. We give people dedicated recovery coaches who are helping you manage the outside world and think about where you're going as you leave from the first week that you're sitting here on campus. And we also bring you to a setting that doesn't feel like a hospital, which we think is also helpful. But uh, to answer how's the business doing, we we had a good first year, not without surprises, though I'm not going to go into the details on that. Um, I had to really rush to learn. I came from finance, but I hadn't been an accountant, so I had to learn how to put books together very quickly. And then we were able to bring on a controller, but it was important that I understood it myself, which was a surprisingly hard thing to do. Learning not only what the sales motion of the business is, but how to accelerate it was a new challenge. Though I think that one happens to all searchers. Is there anywhere you'd like me to dive in more?
Maybe even if you observe yourself, did you feel a nervousness initially that now faded because part of the loan is being paid back? Any even personal changes you perceived, translating also to how you would do things differently.
Definitely things I would have done differently. I'm gonna go back to my sit, listen, and learn. In the first couple of months, you probably cannot move too slowly as long as the business is performing more or less as it once was. When you're in a partnered search, figuring out delineation of duties because there's so much going on that you can't both be in every room. Figuring that out a little bit faster would have given both Ani and I a little bit more bandwidth. One thing we did that was very good was we couldn't actually be patients, but we sat with clinicians, understood what the intake process was, how they set up client treatment plans, did some mock sessions with the therapists. That helped us understand the business very well. I might have done that. Uh, might, so really understanding the customer journey is very helpful to understanding everything else about the business.
And now you are in that company. It sounds like it's going good. It's an interesting niche you're in. And I saw that you also started your own website for searchers. You're giving back, not just with this podcast, but also with searcherinsights.com. What are you doing there?
I talk to searchers fairly frequently, as most people in the space do. And there were a few things I noticed. One, people ask a lot of the same questions over and over, and that everyone's going to go through that process. Some of that's okay, but some of that could just be short circuited by having the information gathered in one place. So we have on the website, we have a list of the typical tools and resources people are using for any given thing. So in deal sourcing software, Beauty, Grata, Udo, Source Scrub as options, just as one example. I found that people typically knew the group of 10 to 15 investors who go around to all the campuses, but they didn't always know that there were 4 times as many investors out there who would at least be willing to talk to you. So I created a database of investors and investor groups so that people would know that there was this bigger universe of people who might be willing to invest in them. Though I will tell you, you probably still need a warm connection to really get a deal done. But nonetheless, the universe is probably bigger than you think it does. And then there's some commentary that I'd like to put out there on my opinions on what it's really like to search and some things that may get missed while searchers think about the journey.
Really cool. So everyone check it out. I repeat it, searcherinsights.com. Have a look. And Brett, if I understood correctly, you're also investing a bit in search funds, right? What about that?
Yeah. So my dad had a very successful career in the financial industry. So when I went and looked at search, it was like, "Oh, this is an interesting thing for you, but it's also an interesting asset class, you know." And I think my dad and I bring different but interesting, helpful perspectives. He spent 40 years in corporate America doing everything you can imagine. He ran and grew businesses. They were typically some sort of a turnaround. Searchers are going to go through some sort of a turnaround during their journey. Uh, did successful M&A. Uh, and then his last journey at Prudential was helping run a large transformation exercise that spanned the whole business, both in the US and internationally. So he gets a lot of wisdom from there. And then I've pretty recently been in the trenches. So I like to think I can give pretty clear eyed advice from both the searcher and the investor perspective, which there's certainly other people out there who have that same perspective, but it's not most of the investors. And then, yeah, we're trying to back, sort of 5 to 8 searchers a year, hoping to do 3 to 5 deals in a given year, typically taking somewhere between 5 to 10% of the cap table. And my dad is now retired, other than managing investments, so he certainly has a lot of time to help, and I try to take calls wherever I can be helpful.
Sounds like an absolute power pair, the junior and the senior all together. Really nice. I think we're coming to an end, Brett. It was a really interesting journey through your life, from your studies to now being in the company you're in. Is there anything, as kind of a last word, anything you want to share?
I'm going to repeat my unsolicited piece of advice who are in the early stages of this. Talk to as many people as possible sooner. It will make your life much easier down the road.
It's a perfect ending, I guess. You can find Brett on LinkedIn. You'll find his website, searcherinsights.com as well. And I'll also put him in the show notes. Brett, thanks for being here and spending your time with us.
Yeah. Thanks for having me.
And that was it. Thanks for staying to the very end. And as always, don't forget to subscribe to this podcast wherever you listen to podcasts, and send me feedback, recommendations, tools, resources, anything I should have a look at and include into this podcast. Contact me at alex@searchers.com. Thanks for being here with me, and stay tuned for the next episode. Bye.